Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Good morning, everyone. My name is Zhong, and welcome to Cut to the Chase. Just when we thought the March frenzy is behind us, April does not want to be outdone and has given us a few surprises. The first was the OPEC Plus cut, which I spoke about yesterday. And the second being the huge miss of the US March ISM Manufacturing Index, a reliable indicator of economic activities which we track in our recession dashboard. On Monday, US government bond yields moved higher on higher oil prices, before retracing and ending lower after the disappointing ISM manufacturing data. Elsewhere, US equity markets also fell initially on the weak data. Let's try to make sense of the market reactions to the data release. Firstly, the ISM manufacturing PMI fell to 46.3 last month, below consensus of 47.5, and marking the lowest level since May 2020 when the pandemic was happening. A historical analysis that came to my desk this morning suggests that there are only 4 instances where the ISM manufacturing index was this low without a recession in the next 12 to 18 months. Secondly, the ISM data showed all subcomponents in contractionary territory for the first time since 2009. The new order specifically plunged to 44.3, erasing half of its rise over the prior month. As a reminder, ISM new orders to inventory ratio is also another indicator we monitor closely in our recession dashboard. With the March data, the ratio has deteriorated further. The only bright spot was the production index, which edged up half a point but remained low. Thirdly, the ISM manufacturing reading has been steadily weakening over the past few months, and that's largely consistent with the trend of the S&P PMI data too. These data are indicative of the weakness in the US manufacturing sector, raising the odds of recession. This leaves investors with 2 specific takeaways. The weakening macro backdrop reconfirms our safe investment approach, which prefers high-grade bonds and more broadly, a diversified basket focused on income generation to ride out the end of the economic cycle. Within equities, we are overweight Asia ex Japan, where China economic recovery is likely to support an improved earnings growth profile. For investors who wish to remain in US equities, we highlight sectors that are defensive in nature. That includes the consumer staples, healthcare, and utilities. These sectors have historically proven to deliver resilient earnings in the downturn and are likely to outperform the broader US market. That's all for today. Please help us to like, rate, and share the podcast. Thank you for your kind attention, and do come back tomorrow for another episode of Cut to the Chase.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.